Hi, I'm Itay. I'm co-founder and CIO here at Equi, and today I'd like to share with you some of the insights that our asset management team is looking at as we're trying to navigate this complicated macro environment. And let's start with the Bloomberg terminal here. What you can see in the white line is the S&P 500 index. What you can see here in the orange line is HYG. HYG is a proxy ETF for corporate debt or high yield corporate debt. What we've noticed over the past year or so is that the S&P 500 and HYG have been trading in tandem. What we did notice, however, that was kind of interesting is we've seen price divergences at all the recent bear market rallies. When they were topping out, we saw HYG starting to roll over, and then soon enough, S&P caught in and caught down, I would say. And then eventually, there was another down leg in the bear market. We saw that in August. We saw a version of that here in April. And we saw that in December as well. You can see a decoupling between the S&P prices and HYG, and then they caught in. We're seeing the biggest divergence right now between high yield bond prices. And that could be a measurement of liquidity as well, right? Because high yield bonds are the most liquidity sensitive, or I would say they're more liquidity sensitive than the equities, and they sniff out problems sooner. So we're seeing this rolling over quite a bit, actually more than we did in August, more than we did in December. And the S&P is slowly starting to roll over, as we've seen this past week or two. So again, remains to be seen whether or not we're going to see a broader S&P decline catching down to this HYG as we've seen in prior times. We're also seeing that with the TLT ETF, which is a measurement of the US Treasury market. So in this case, it would be it's actually a 20-year, so it's a mix of the 10 and 30, but very similar situation. The Fed said they're going to stay higher for longer, and the bond market is starting to believe them, really rolling over here, but equity markets are taking a longer time to realize that is the case. So again, in 2022, we've seen bonds and stock being incredibly correlated, and as the bond market rolled over, so did equities. The biggest question, I think, for the early part of 23 is this relationship going to continue, or are we actually breaking correlation between bonds and equities, which is certainly possible. We've seen that in more of a bull market regime. So I'll leave you with that and see you next week.